Right, good evening and welcome to the India Development Debate right here on ET Now. I'm Supriya, Shrinate, and with me is Sandeep, Gurumurthy. Also coming up on the second half of the India Development Debate, we get you a direct interaction with none other than the Vice Chairman of Niti Aayog, Rajiv Kumar, on today's policy action. But let's take it straight across to what the RBI did today. It has fired the interest rate shotgun to keep inflation under check. Heralding the end of the easy money policy regime, the Monetary Policy Committee unanimously voted for a 25 basis points hike in repo rate, the first rate hike under the Modi government and the first since January of 2014. In fact, this is the first interest rate hike, like we just said, in the last 4.5 years. Announcing the MPC's decision, Governor Urjit Patel said that despite the hike in the benchmark rate, the stance has been kept neutral, giving the central bank the flexibility to move in either direction if the macros change.
On growth, the central bank continued to sound bullish, keeping the FY19 GDP growth target at 7.4%. After the second bi-monthly review of the current fiscal, the MPC said there is a marked pickup in private investment too. The RBI also announced measures to ease liquidity conditions by lowering the bar on the mandatory SLR requirement. And the market seems to be liking it, led by banks. Sensex jump over 275 points, the biggest single-day gain in the past 6 trading sessions. Economists and experts say, although unexpected, the rate hike is a step in the right direction, especially considering the spike in core inflation. The first rate hike in over 4 years and what it means to industry, economy and the market at large. That's the topic of discussion tonight on the India Development Debate. Joining us on the show is a stellar panel: Sajid Chinoy, Asia Economics lead at JP Morgan; Anand Narayan, money market expert; Shobna Kaminini, former president CII; and Maithili Busrur, consulting editor of ET Now. Sajid, let me start off with your policy rate hike after 4.5 years. What is this rate action in response to weak currency, the oil price hike that we've seen, persistent inflation, or the Fed's shrinking balance sheet?
I think the central bank was quite clear. I think we have now a very transparent inflation targeting framework, and I think what matters to the MPC is where is inflation going to be 3 or 4 quarters from now. And I think what the MPC tells us is that year ahead they've seen inflation forecasts go up. So their second half inflation forecast for this fiscal year was increased from 4.4 to 4.7. Now we need to be careful there because the first part of that forecast, which is October, November, December of this year, benefits from a very large favorable base effect. So implicit in that increase in inflation forecast is the fact that the RBI now sees inflation 1 year ahead at above 5%. And I think that's what caused them to move today, because their medium-term target is 4%. And now what they're telling us is 1 year ahead inflation is running or is projected to be closer to above 5%. And therefore they raised the policy rates today. So I think the communication was very clear that going forward, policy will be made very much on where inflation is forecasted to be, and all the other factors you mentioned, higher oil prices, a weaker rupee, tighter financial conditions globally, all of that will matter insofar as it spills over into higher forecasted inflation.
Okay, so the central line for all of this is going to be inflation targeting, as Sajid says. That might come in on that. Since the April meeting, where the governor said he will wait for data, look at how oil prices have moved up from $66 a barrel to $74 a barrel today, which is about a 12% rise. Rupee has weakened since last policy by 3%, and the Q4 growth in the last fiscal has revived to 7.7%. Was the data stacked overwhelmingly in favor of a hike?
Well, yes, because I think since April there have been some dramatic changes, particularly as far as oil prices are concerned. In fact, I am a little surprised that the first half of the year they have not really increased the inflation projection as much as I would have expected. But I think it's partly because of the base effect, as a result of which in fact the increase in the inflation rate is only in the second half, especially because of oil prices. Remember also there is the issue of the MSP. We've seen the MSP increases for 3 commodities, but the government has been very clear that they will announce fairly generous MSPs hikes, particularly since we're seeing so much unrest in the rural areas. So almost everything except for the fiscal deficit, where the government has been able to stick to the target, which has been on track, almost everything else has moved against inflation being kept under check. So given that the RBI is an inflation targeter and it's almost fixated, if I can use the word, about that 4%, and has always interpreted the inflation target as an inflexible rather than a flexible inflation target, I'm not surprised that they acted as they did and saw inflation as a big threat, which it certainly is, particularly because commodity prices are rising. And remember, next week we will see the Fed meet, and the Fed is almost certain to hike interest rates. So the RBI really had no option. It was basically playing catch up with the market, because the market had gone way ahead of the central bank and had increased interest rates quite dramatically. In fact, since April, bond yields have gone up by almost 73 basis points. So the RBI is essentially playing catch up to the market.
Oh yes, didn't want to be caught behind the curve, the central bank there. But let's get a view from the industry. Shobna Kamineni, how big a deal is this for corporate India? This is the first rate hike in 4.5 years. And does this, in a sense, signal a decisive turn in the rate cycle?
I think that the quantum of increase clearly shows that the RBI is in sync to help the country continue its growth path, because industry is doing well. You got the figures, 7.4. In fact, that was the last couple of months have continued to be good. The consumption cycle has gone up. Construction is doing well. Of course, the two-wheelers and four-wheelers, the auto industry is actually booming, you can say, after many years. So this rate hike, I think, was conservative and appreciated from all sides.
Okay, so the RBI does keep the growth concerns also in focus as it talks about revival, but I do want to talk about how unanimous this verdict really was. And Anant, let me come to you. Are you surprised that this was a unanimous decision? The last 4 decisions of the MPC have been a fractured mandate, and today all 6 members voted for a hike. Even doves in the policy like a Pammi Dua and a Dholakia have made a case for a rate hike. Now, what does that signal?
It's a pleasant surprise, Supriya. I think after a long time we're getting a complete consensus, and it's good to know that the 6 wise people around the table have agreed and come to a complete consensus. I think the reason why it was easier to form a consensus is because it's been a balanced approach from the MPC. They have taken cognizance of the fact that since the April policy, there have been some visible changes to the underlying data flow. Clearly, core inflation has ticked up quite sharply. Oil prices have gone up as well, and the global context, as the policy pans out, has changed for the worse. So, all put together, there were clear reasons to expect that inflation should tick up from here. And following the mandate, as Sajid pointed out, it was only incumbent for everybody to recognize that inflation is now a risk, and therefore they should go ahead. Now, notice also that they have not changed the stance really from a neutral stance to a hiking stance or reversing the stance there. And that allowed, I guess, the doves also to come in on board. One thing I will point out, though, is that the entire policy is predicated on assuming that the fiscal deficit targets will be met. While analysts like us can sit down and say that, the fiscal deficit is going to be tough to meet because of a variety of reasons. One, GST, projections are pretty ambitious. Even though GST collections will go up, it's still a very ambitious target. We know that MSPs are going to come through, and in an election year, we will see doles of that kind coming through. And plus, oil prices are still pretty high. In rupee terms, oil prices today are 30% higher than the last fiscal year. So given all of that, we do think that fiscal deficit will be breached, but the policy statement clearly states that they have assumed that the fiscal deficit targets will be met. In fact, I think that will be the next moving point as far as the policy MPC is concerned. If in June or if in August they do get the sense that MSPs are higher than expected, and therefore there's increased risk on the fiscal front, you might see one more rate hike coming through or a change in the policy stance coming through. But for now, it's been a balanced approach and a wait and watch approach.
So you're saying the variable from here is going to be what happens on the fisc. But Sajid, just to play the devil's advocate, since there seems to be a consensus in the panel on the rate action of the central bank, do you believe the central bank has managed to separate the signal from the noise when it comes to reading the inflation data? Yes, core inflation has spiked to 5.92% in April, but much of it is on account of the base effect and could well be transitory, as the Niti Aayog Vice Chairman pointed out a couple of days ago. And in any case, April CPI at 4.58% is sort of not, too way off the comfort range. I mean, it's 4% plus or minus 2%. That's the range that the RBI is working with. Could it not have been in a wait and watch mode, Sajid?
Well, I think core inflation has gone up not just because of base effects. If you look at the month-on-month increases and you look at core inflation very closely, you take out petrol, take out diesel, take out housing, which has been impacted by the HRA allowances, what you will find is for the last 6 months, since the month of October, the average momentum has been almost 0.5%. So on an annualized basis, what we've been discussing for a while is underlying inflation is now tracking above 5%. And I think it was that consistency in the strength of underlying inflation that ultimately forced the MPC's hand. So I don't agree that core inflation has only gone up because of base effects. It is true that food prices continue to undershoot. And that is going to provide some near-term relief. But I think ultimately what matters in this framework is where is inflation forecast to be 3 or 4 quarters from now. And the RBI forecasts it to be 4.7% for the second half of the fiscal year. But really what that means is they're seeing inflation in the first quarter of next year above 5%. And this is, I think, quite consistent with various market forecasts as well. I think most market participants now, if oil prices remain at $75 a barrel and India undergoes a reasonably strong growth recovery, are foreseeing inflation at 5%. So if 4% is the midpoint of your band and you are seeing inflation consistently around 5%, I think that's the reason that the MPC moved today.
No, I agree with you. I think an institution that has taken upon itself to target inflation at 4% was not going to act at all, especially with core inflation, which is minus food and fuel, ranging at levels of 5.3, 5.9 and all of that. But Maithili, I have a quick question, and these are really voices from New Delhi. People like Rajiv Kumar have advocated that core inflation is transitory in nature. HRA and all of that, and fees, education and all of that is transitory, is perhaps paid in the first half and then will wane off. So on account of that, do you believe it is as stubborn as the RBI is apprehensive about? And also food, for instance, the composition change that we are seeing in inflation, food inflation has been rather benign. We haven't seen the seasonal jump in vegetables that we usually do. Is RBI perhaps being overly cautious on inflation at this stage?
Well, I wouldn't think so. Of course, RBI has traditionally been an inflation hawk under the inflation targeting regime. But the fact is that, frankly, core inflation doesn't have very much meaning in a country like India, where in the consumption basket, food and fuel account for an overwhelming part of the consumption basket. In the CPI, which is the target for the Reserve Bank of India, food alone comes to almost 50%, add fuel it comes to almost 60%. So in a country like India, to talk of core inflation is quite meaningless in my point of view, unlike in the case of the US, where food constitutes a very small part of the consumption basket. But despite that, even if you ignore the fact that the RBI is focusing on, you can argue whether RBI should or should not focus on core, the fact is almost all the portents would suggest that inflation is going to pick up, and the fact that food inflation has not picked up right now, you should not draw too much comfort from it, because remember, in India, it's a very fine balance between demand and supply. Some small strike, a hartal somewhere, some flood somewhere, and immediately everything gets thrown out of gear. Even now we are seeing the farmers' agitation, and it has pushed up prices of fruits and vegetables. So I wouldn't attach too much importance to the fact that so far food inflation hasn't gone up. It's always touch and go as far as food inflation is concerned. So here, particularly if the portents are for a rise, I think it is better, particularly because monetary policy should be forward looking to hike the rates. And 25 basis points, as I said, is neither here nor there. Markets in fact have pushed up rates much more.
Fair enough. Shobna, I have to ask you about your own outlook on what's going to happen through the course of this financial year. Most economists in the street are betting on 2 rate hikes by the RBI this year, one of which has already come through. What's your own sense? Are we likely to see another 0.25% rate hike, and when do you see the next move happening?
I think that there's a lot of global uncertainty going on at this point of time in trade wars, We're looking at exports that are actually kind of stagnant. We need to push that up. So when you look at the global market, you look at what's happening today in India, I think this rate hike is something that we might see another 0.25%. I do not think that RBI will get very aggressive, because I see that a good monsoon will make sure that food security will endure, that will make enough inroads, that now investment will start coming back as the economy moves up. I think that we can take another 0.25%. This year is actually going to see a lot of what the government has done over the last three years will now start actually, will come to fruition. And I think that this is something that we have to all work towards and safeguard, because we just came out of a National Council meeting and we went through many sectors, and all of them, not only are they doing well today, but they do think that that this is going to stay for some time to come. Of course, there's certain sectors that, in services that need to actually be boosted up, because we have to understand that manufacturing is manufacturing and production, infrastructure, all those are moving up. We need to make sure that enough is given to services. And I think overall we're looking at a better economic future, especially over this year.
Okay. A better economic future over this year, and I'm going to take a question a little later on, that is this all a sign of survival like New Delhi asserts it is. But Anand, has the RBI given itself elbow room to pause or in fact even cut rates if and when the government does come up with a new formula for fuel prices? I mean, the policy stance is neutral and it's based, like the governor insisted, it's based on a total pass-through of prices. You and I both know in an election year, and if crude continues to rise, the government is devising a new formula. The consumer will have to be ring-fenced, which will mean inflation figures will change. Will this also mean that stance will change and so will policy?
Well, Supriya, the MPC clearly has given itself some room, and the governor reiterated that in the press conference today by keeping the stance neutral, which means depending on which way the data flows, they can actually take a call. But if you notice, the document and the subsequent press conference talked more about the upside risks to inflation and to overall financial stability as well. I tend to agree with Maithili. In a context like India, it's very difficult to hazard a guess on where headline CPI will be in a year's time, because effectively it becomes taking a call on where food prices and oil and commodity prices will be in a year's time. And frankly, if we had an answer to that, we wouldn't be wasting it on models, we'll be trading the markets. So at a time like that, in a context like this, it becomes important to look at financial stability factors. And if you look at the global context and the local context, things aren't looking too great. Clearly in the global markets, we are seeing withdrawal of monetary accommodation globally. We are seeing geopolitical risks, which is keeping oil on the boil. And even domestically, we have issues. We have imbalances coming up both on the current account and the external front, as well as possible imbalances coming up on the fiscal front. Now that concoction and combination of dual deficits can be pretty troublesome from a financial stability perspective. And eventually financial instability can feed into inflation. Now, mind you, today oil has come off a little bit. If oil comes down back again to 60 and below, all of this will be behind us. But unfortunately, we can't run policy on the basis of hope and prayer. We have to be prepared for the worst. And as things stand today, the balance does look like we are in for troublesome times on financial stability. And therefore, the RBI and the MPC will likely be cautious. Personally, I do think, given the context on the dual twin deficits, we are likely to see at least 50 basis points of hikes for this calendar year.
50 basis points of hike for this calendar year. That's seems to be the consensus view on the street and the consensus in our panel as well. Maithili, even though Shobna representing the industry is sort of far more optimistic on the general investment outlook, the fact remains that investment and credit offtake are both nascent. We're seeing early signs of revival. What impact will a 0.25% hike in rates have on investment, or is that something that's been budgeted for in some sense?
Well, none at all really, because as I said, interest rates have gone up much higher than by 25 basis points, and interest is only one factor in an investment decision. Far more important are things like, ease of doing business, policy, if there's consistency in policy, and in all fairness to the government has been spending in a fairly wise way. So government spending can always have two effects. It can either crowd out private investment or it can crowd in private investment. To the extent that a great deal of investment has happened in areas like roads, etc., and the government is trying to think in terms of a rescue package for the power sector, which is highly stressed. I think you should see private investment crowding in, and the governor has already talked about how the output gap is almost closed, is the word that he used. So once the output gap is closed and capacity utilization has picked up, then investment should follow. So I think industry does not need to get distressed by about that 25 basis point hike, which is why I think we saw the stock markets, which are usually forward looking. Of course, one can never go entirely by the stock market, but even so, I think industry is not really stressed out, and that is really a good sign.
Industry isn't stressed out, but let's ask somebody who's got her skin in the game as far as interest rates are concerned. And Shobana Kamineni, the interest rate versus the investment ratio, the equation, is that an exaggeration? I mean, lower interest rates did not see a huge revival in private capex. Will slightly higher rates hurt investment at all, or is this are these two completely divorced, at least at this stage, where other things like capacity utilization, demand, consumption and all of that matter?
In our current reality, the big picture is to get the banks lending again, because lending to companies is still insufficient, and I think that once the banks come back to play, most of this is coming out of NBFCs, but that's what you're seeing, and working capital. When real investments start, that's when the credit offtake will start happening, and I think that a 0.25% is really not going to be significantly a deterring factor in this, because if they do have the current scenario of the way growth is looking, I think companies will definitely invest. It's the banks that now need to come back into action. That is a bigger concern for us.
Okay, the bigger concern is to get banks to lend again, and there seems to be, credit flow seems to have choked on account of a whole host of other reasons, and the interest rate hike won't necessarily make a difference. That's the view from corporate India. But Sajid, let's come to you and talk about the other variable that Anant was referring to earlier in the show, which could have a bearing on what happens on interest rates from here on, which is the fiscal deficit. And what's your own sense? Won't it be increasingly challenging to meet the fiscal deficit target at 3.3%, given where oil prices are, given the sort of government's push towards more populist policies? We've seen a bailout package for the sugar industry. We're also looking at at MSP divisions through the course of this year. So what bearing will all of this have on the next policy action? Sajid?
I think we should not prejudge the fiscal. I think the government has been as responsible as possible under the circumstances. What's been very encouraging from a fiscal perspective is the government has not bucked to the pressure to cut excise duties even when oil prices had almost touched 80. I think that signals a very firm resolve by the government to stick to its fiscal consolidation limits. I think the budget has been very responsible because expenditure to GDP actually was brought down in a pre-election year, which is very, I think, admirable. I think the key uncertainties lie on the revenue side. One is how do GST tax collections pan out, and the second is what happens to disinvestment. Now, GST collections have slowly been increasing, so the hope is that that process continues once the e-way bill takes more hold, that you'll have more tax buoyancy from GST. So, at this point, let's not prejudge that we're going to see fiscal slippage at all. I think the government has done its best to try and hold the line on the fiscal, and we hope that happens this year as well.
Okay, I think Sajid is being far more charitable on the fisc than Anant has been in the past. And Anant, while we talk about the fisc, we understand that the entire oil bounty is perhaps all set to dissipate. I mean, whether oil reduces, whether it's the excise duty cut or whether it's a new formula, that bounty is going to wane. Given how challenging it has been to meet the fisc in the past, and all 4 years we've just kind of extended the goalpost, how challenging is 2019, fiscal year 2019 and 3.3% going to be? And I obviously want to understand, the governor and his team may have today had in mind the US Fed's balance sheet shrinkage and all of that, but it's going to be fiscal concerns quite next.
Well, yes, I do think the fiscal is going to be a challenge. And look, the last year in fiscal 18, yes, the government did finally, the central government did meet, 3.5%, which is unchanged from the previous year, FY17. But the quality of the budget, frankly, I thought was a little disappointing. I know we've moved away from looking at revenue deficits, which is somewhat disappointing. But the year we chose to move away from revenue deficit targets in the FRBM, we suddenly moved from 2% budget for revenue deficits to 2.6% actually realized on the provisional numbers. Likewise, capital expenditure was actually lower in absolute terms in FY18 compared to FY17. And these are not good signs. Now, going into FY19, there are multiple challenges. One, as Sajid pointed out, GST collections are ambitious, the targets are ambitious. I do think GST is a fantastic long-term positive, and they will pay dividends and increase the tax to GDP ratio at some stage, but it does take time. It doesn't happen overnight. So this year might be a bit of a challenge. Plus, on the expenditure front, as Sandeep also mentioned, we've got MSPs coming up. It's an election year. We also don't know how the oil prices are going to play out. And, as oil goes up, it's a double whammy on two fronts. One is your subsidy expenditures go up, and plus you're giving up a huge bonanza which you've been earning all this while, because the government did the right thing and didn't pass on the entire oil prices cut in the last 3 years onto the consumer. And today, between state government and central government, they earn about 2.8% of GDP from oil alone, which is actually more than what Malaysia earns from, and Malaysia is a net oil producer. So this includes customs, this includes excise, this includes state VAT, this includes dividends and taxes that the oil companies pay. It's a huge money spinner for the government. Now, as oil prices go up, of course, like I said earlier, if oil prices come back down to 60 and shale gas saves the day for us, great. I mean, we're all home and everybody's happy. But, if oil prices stay where they are right now, then there is going to be a challenge on both the revenue as well as on the expenditure front as far as the government is concerned. In this year, I think the fiscal deficit can be a challenge.
No, I agree with you, and especially in the last policy, I think the basis of crude oil prices was $68 a barrel, and obviously that trajectory has moved quite significantly. But Maithili, I want to ask you the other question, and most people that you're speaking to in New Delhi, or the voices that are coming from there, whether it's the Vice Chairman of the Niti Aayog or the Interim Finance Minister Piyush Goyal himself, or the Department of Economic Affairs Secretary, the message from New Delhi, and at least the spin, if I may call it, and I'm taking the liberty of calling it a spin that's being given to the policy, is that this is a vote for revival of economic activity. This is a vote for speedier resolution of NPAs. This is a vote for a boost to investments. Are you going to be as optimistic when you look at today's policy?
Well, I wouldn't think the policy per se is going to give any boost to investment, except to the extent that the RBI now seems to be getting realistic about controlling inflation, at the same time being pragmatic, in the sense that they didn't want to spook the market by taking a more hawkish tone. So they maintained that neutral stance, saying that they're very open to the idea that if inflation pressures come down, they're perfectly willing to cut rates. They haven't made any promises, but they're saying we have a neutral stance. So I think it's a right angle that they have taken. So to that extent, yes, it should boost investment, but as I repeat again, investment is determined not only by interest rate. As important as the cost of credit is the availability of credit, and on that I think the RBI has not done enough. It has done something in terms of taking some part of the SLR towards LCR, the liquidity coverage ratio, and that should increase the ability of banks to lend. But until such time as RBI becomes a little bit more pragmatic about allowing public sector banks to take deposits and lend, that is multiplier creation of credit, because that's what the banking system is all about. It needs to be a little bit more relaxed about its PCA, because as long as the NPA problem is there, if along with NPAs you also have the PCA issue, you are not going to get banks lending, and availability of credit is as important as the cost of credit. So I think RBI is looking only at the cost of credit, so I think it needs to do a little bit more in order to ensure availability as well.
That's a point that Shobna made earlier in the show as well. Closing comments, and since Supriya spoke about it, I must read out the tweet of the interim finance minister Piyush Goyal. He says, "I welcome RBI's monetary policy, which confirms that economic activity is on the upswing and expects a boost to investments." I can't remember the last time, a finance minister has welcomed a policy where the interest rates have been increased by 25 basis points, but that's certainly good news. But Sajid, let's step back and look at the bigger macro picture. You have a rate cycle that has turned, inflation that's inching, current account deficit that's likely to be at the highest in 6 years, fiscal deficit that's sort of under stress, and a rupee that's weakened considerably. Are the fault lines, the macroeconomic fault lines, now a little more visible, no matter what the government would like us to believe? Sajid.
No, in fact, quite the opposite. I think that all of what you mentioned, despite all of what you mentioned, we are much better prepared than we were in 2013. I think India's starting points, India's macro fundamentals are much stronger than we were in 2013. Our starting points are better, and we've got significantly higher buffers. I mean, coming into 2013, inflation was running at 10% a year. Coming into this episode of global stress, inflation has been running at 4% over the last year. Our twin deficits, current account deficit and fiscal deficit, yes, they've gone up a little bit over the last year, but they're still meaningfully below where they were in 2013. Number three, we've got a significant buffer of foreign exchange reserves, and our gross financing and our reserves ratio to gross financing requirements is almost 1.5 times that we saw in 2013. So I think quite the opposite, that India enters any period of global stress much more fortified than we were in 2013. I think today's rate hike and commitment to the inflation target simply increases that insulation to global shock. So I think that's been recognized around the world, that from being in the fragile 5 back in 2013, I think more and more, helped of course by lower oil prices, India is being considered one of the safe havens in the emerging market universe.
Point taken, and I don't think the comparison with 2013 is fair, but I think the comparison with where we were 2 years back is what we're largely looking at, and it does seem like macros have deteriorated in the last 2 years, largely on account of what's happened with crude. Shobna Kamaneni, I'll let you have the last word on the show. Will this sort of tug of war between bad macro and good micro, because the granular data is very good, CV sales, cement output sales, etc., tourist arrivals, the granular micro data is good, the macro picture overall not as good as it was a couple of years back. Do you see this panning out through FY18, and what does this mean from an overall economic standpoint?
So, I think that India Inc. is just tired of holding back. We've been talking about putting in investments for a long time. They needed to see some signs, and the consumer growth the consumer offtake is really the most encouraging sign of what's to come. I think that we have strong fundamentals domestically. So you will see that many of the industries, I want real estate to come back, and then the government is actually spending wisely on infrastructure, not just about roads, what we heard about in the last 2 years, but now we've even heard that large rail contracts have been given. So infrastructure is ticking up. They're working on the stressed power assets, and power pricing is going up. So I think that we're seeing some good things happening in that sector. So infrastructure ticks my box, where steel production, cement, and actually a lot of the investments that were put in place now, industries have reached 75%. The manufacturing industries have reached 75%. They will start investing, and I think I said that last year also, that we should wait for the first quarter of this year. It's going as per plan, maybe a couple of months behind, but I think that the future looks like we're just going to accelerate. So Indian industry is quite hopeful and bullish. When you spoke about India being the global safe haven, I think that this is it. Ease of doing business will continue to get better, and I think that the states also play an important role. We can never forget what's going on there. So I think that fiscal prudence from their side will only help in attracting more industries to the states. So overall, it's probably going to be a good year for us.
All right, on that note, thank you very much all of you for joining us on this edition of the India Development Debate. Shobhana Kamineni, Sajid Chinoy, Anand Narayan and our very own Maithili Pusnur Mart. It's a pleasure chatting with all of you on RBI's monetary policy action, the first policy hike that we are seeing in the last 4.5 years. Is this a vote for growth that's picking up, or is the RBI perhaps being proactive in trying to rein in inflation? We'll have to wait and watch what they have to say on the 1st of August for this. Thanks very much for being with us.
But don't go anywhere. We're going to slip into a short break. On the other side of the break, joining us will be the Vice Chairman of the Niti Aayog, Dr. Rajiv Kumar, for an IDD Direct. 2 days before the policy, he said it would be an overreaction if the RBI were to hike rates. Does he still hold that view? We're going to ask him in just a few minutes on this special edition of the India Development Debate. Keep it with ET Now.